Good morning, everybody. Welcome to another day of Market Report brought to you by Mike Bjork. Today is Hump Day. It's Wednesday, September 2nd. Hey, we got a bit of economic news release, so we're going to jump right into it today. We'll start out with the ADP employment numbers. So remember, we got the numbers from the Bureau of Labor Statistics on Friday, so that's going to be our big day today, big day this week. But with the ADP, the private jobs sector, we had 177,000 jobs last month, and then for the month of August, well, actually July, excuse me, in August came in at 190,000. So a decent number. It shows some steady improvement in the job numbers. We got the productivity in second quarter also shows increase, so it went from 1.3% and it exceeded the forecast at 3.3, beating out 3.2. On the other hand, we got the unit labor cost of second quarter. In my opinion, this is something to keep an eye on because we've been watching the inflation numbers so low that the unit cost went down on this one. So the last report we had was at 0.5%, and the forecast came in at negative 1.4%, and it came in. So this creates more pressure on inflation, and I think this is something we do have to keep an eye on here. Factory orders for the month of July. So we had back in June 2.2% factory orders, forecast at 1, and it came in a bit lower. So we're starting to see, as we saw with some of the manufacturing kind of weakening a little bit, factory orders also dipped here. And later today, we got the Fed base book coming out around 11 o'clock Pacific Standard Time. So that could create some volatility in the markets, primarily because there's still little uncertainty as to the direction of where the Fed's going to go in terms of rates. Are they going to raise rates in September, or are they going to wait later in the year? The data is, they still, a lot of them still have come out and said that it's not off the table for the month of September. So it is a possibility it could be in September. Personally, I think they're going to have to wait, primarily because inflation is just too low, especially when it went backwards from 1.3 to 1.2. And with things on the commodity levels, the emerging markets, I think that could, and oil prices expected to go lower, I think that could create more pressure in terms of inflation. So going lower, and maybe possible problem with deflation now. So that's my personal note. Market's up right now. A lot of it has to do with China markets rallied a little bit, so I figured there's some stability over the Chinese markets. And then what's also going to help out for the rest of the week is that they're closed due to the World War II victory celebration. So they're closed on Thursday and Friday, Chinese markets. So we don't have to worry about the Chinese markets tumbling or creating more havoc into the equity markets here on the global level here. Let's take a look here at the bond market. We are down today. We're down right now about 9 basis points. We were down further, as you can see by the tail. We were testing the 25-day moving average, which has been kind of a floor support. So every time we touch it, you see this green line here, we've bounced up. Every time we've touched it, bounced up. We've always kind of rebounded backwards, upwards there. And then we also have this 200-day moving average. So as you can see, this is moving upwards, and this is kind of moving more of a straight line. At some point, they're going to meet, and it's going to force us. One's been a strong floor ceiling, and one's been a strong support, and it's going to have to break one way or the other. So either we're going to have a rally in the bond market, or we're going to have it's going to tank here. So it's going to depend on the Feds. So some people think this could be projected by this Friday, but it's a little soon. As you can see, it's slightly going up, and we have a few more days until we reach that. So this something could be until next week, until we get forced with a decision. But Friday could be a good telltale as to the direction as well with the jobs numbers. So if projections, at least my projections are, if we have a weak jobs number, then I think the stock market is going to rally, primarily because I think they're going to figure that the Fed will see this before they have their meeting and probably hold off. If we have a strong jobs number, I think the stock markets will tank, and they'll be concerned that the Fed will go ahead and raise rates. And as meanwhile, the opposite will help for the bond market. So if we have a bad jobs number, it'll be bad for the interest rates will worsen. If we have a good jobs number, interest rates will lower as a result. So in this case, good news is bad news type of thing for the equity markets. All right, you guys have a wonderful day, and we'll see you guys tomorrow. Thanks so much for watching. Take care.